Hello everyone, welcome to Demand Supply Trading Practical Session number 44 for the year 2025. Myself Srijit Kakkar, and today is Sunday 16th of November 2025, and before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. Plus, on this channel, we also update you when these live sessions are scheduled so that you know them well in advance and you can plan your day accordingly in case you want to join these sessions live. And plus, if we have any offers or promotions coming up, that is where you will get to know about these offers and promotion, as soon as we launch them. All right, now to join this Telegram channel, there are a few different ways you can do it. The first and foremost is you can see you have this QR code on your screen. You can scan the QR code and you can be part of the channel. Next, if you go to the description of this video, you'll be able to find the direct link, and using that link, you can again join this Telegram channel. And thirdly, when you visit our website, which is srijitkakkar.com, or you can use the short URL, which is sk.coach. So just give me a second. So once you visit our website, all you need to do is just scroll down on any of the pages, and in the footer section, you'll be able to find this banner which says join Telegram channel, and in front of it, you can see you have the join now button. You can click on this button and you can be part of our Telegram channel. So these are a few different ways how you can join the Telegram channel. Now, talking about today's session is a practical application of demand supply trading methodology. So our demand supply course is now available as a 100% free course. And this course covers both the theory as well as the practical sessions. Now, how do you access the theory? We'll talk about it as we move forward. But once you go through the theory, you basically learn the complete methodology. What is demand supply, how to identify zones, how to qualify zones, how to plan trades. But what happens is, unless and until we see some practical examples, at times we don't get a very good understanding of how the methodology has to be applied. And that is what we do in these practical sessions. So almost every other weekend, I do a practical session where we take some real life examples, and to those examples, we apply the complete methodology, and that helps you understand how to plan trades in a very mechanical and rule based way. Now, there are two advantages of these sessions. Advantage number one, that in these sessions, we are not analyzing something which has already happened, because that is something which always I always say that it's a piece of cake. Anyone can pick up any chart, apply a number of indicators, a number of oscillators, and can justify the moves which have already happened. But in demand supply, what we do is we always pre-plan where are the areas of demand and supply. So whenever we are doing the analysis, we are doing the analysis in advance, and nothing can be more transparent than that, because nobody knows what is going to happen in the future. So all the analysis that I share with you, we're always analyzing in advance where are the areas of demand and supply. And just because I'm doing the analysis in advance does not mean that I share the analysis with you and then we forget about it. Whatever analysis I share with you, whenever they get triggered in the future, we also review them. So that helps you see both the before as well as the after. And when you start seeing the both before as well as the after, eventually it starts building up confidence in the methodology. And that is where you start leaning more against demand and supply and maybe using less of conventional technical analysis. So that's the very first advantage of these practical sessions. Second is that if you have any questions, queries related to trading or even to demand supply trading, you can always put your questions in the chat box, because this is a live session. I'll be answering your questions, queries, but mind it, I will be taking all the queries at the end of the session. So once we are done with our analysis part, at the end of the session, I'll go through those questions and I'll try to answer all the questions, queries that we have in the chat box. Now, to be comfortable with these sessions, there are few prerequisites, and if you complete these prerequisites, these sessions will be much more easier and fruitful for you. So let's talk about what these prerequisites are. The very first one is our Trading Essential course, optional for someone who already has a very good trading background. But I would still highly recommend that, irrespective from what background you're coming from, whether you're starting as a fresher or whether you have been trading for a number of months or years, do start with the Trading Essentials course. Now, how do you access the Trading Essentials course? Very simple. Once you're on our website, you can see under services, you have this option which says courses. Click on it. And here you can see the very first one is Trading Essentials. Click on Trading Essentials. And this course is available in two languages, English and Hindi. So whatever language you're comfortable with, just click on that. You will get immediate access to the complete course content. The course is laid out in a very systematic manner for you. You have lesson 1, lesson 2, lesson 3. So just go through all the lessons. And once you're done with all the lessons, that basically covers your Trading Essentials course. Now, again, very important, no sign up required, no registration required. As soon as you click on this button, you get immediate access to the course content. Now, once you're done with the Trading Essentials course, the next step is your demand supply trading course, because you also need to learn demand supply methodology. Now, how do you get access to the demand supply trading course? Very simple. Under services, go to courses, and you can see the next option is demand supply trading. Just click on it. And you can see this is also available in both languages, English and Hindi. And again, no signups required, no registration required. You just click on them, you get immediate access to the course content. Now, when you go through the course, you basically learn the methodology theoretically, like I was already talking about at the starting of the session. But unless and until you see some practical examples, at times we don't get a very good understanding of how it has to be implemented. So that is where you also have the recordings of the previous practical sessions available to you. So if you click on practical sessions, they are also available in 2 languages, English and Hindi. Currently, the archive is getting closer to almost 2 years of recording. So you have a lot of content available to you, and absolutely 100% free. So go through as many sessions as possible, because the more number of examples you will see, the better you'll start having the understanding of the demand supply trading methodology. So these are the first 2 prerequisites. After that, we have 2 documents, which is the rule book and the flow chart. So during the live session, you will see that I use these 2 documents to plan trades in a very mechanical and rule-based way. Now, how do you download these documents? Let's also talk about it. It's very simple. Once you're on a website, under services, you can see also have the option for downloads. Click on it. And this is where you can see you have your 2 documents, which is the rule book and the flow chart. So just click on download, and you can download these documents. So this is the rule book, and this one is the flow chart. Perfect. So now that we are done with all the prerequisites, we can get started with our analysis for today. But before we do that, we do have one trade from the previous session which is getting carried forward. So let's quickly review it, and after reviewing it, then we'll start our analysis for today. And I would definitely like to add that when we do the analysis for today's session, you will see it's a setup which is, I won't say unique, but it is covering a lot of rules that we have in the rule book, right? And it is also unique in a sense that we have seen cases where we have demand, but we don't have supply for uh, doing our curve analysis. Plus, I can also say that I can also consider this as an example where a symbol was making all-time lows, and when it is making all-time lows, when is probably the right time we can start looking into creating long trades on such symbols, right? So it's a very beautiful example, and I guess it's also an example of level on top of level. So okay, it will be covering a lot of rules which we already have in the rule book. All right, now like I said, we'll start with a review, so just give me a minute. So the only trade which is getting carried forward for us was from session number 37. We did the session on the 28th of September, and the prices came into the zone on the 8th of October. And then you can see we started moving up from the zone. We got the opportunity to make it as a break-even trade, because once it passes 1:1, we can always make our trade as a break-even trade. But what happened during the week, you can see during the week we came back into the zone, and this trade would be now closed as a break-even trade for us. So just give me a second. Let me note it down that this will be closed as a break-even trade. So that was the only example which was getting carried forward for us. And now that we are done with it, we can start with our analysis for today. So just give me a second. Let me bring up the chart for today's analysis. Just a few more seconds. All right, so let's get started. Now, whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based? I have explained this in a video. The title of that video is How to Start Trading. The link is available in the description. So do ensure you watch that video and understand and follow the process that I've explained in that video, because there is no bypassing it. Eventually, everyone will have to go through that process, maybe twice, maybe thrice, maybe even more number of times. And that is the only way to shift from a person who's planning trades based on emotions versus to a trader who's planning trades based on rules, and that is something which cannot be bypassed. So eventually you will have to go through that process. So the sooner you start, the better it is going to be for your trades. So try to go through that video, try to implement whatever process I've explained in that video, and the sooner you start with that process, the better it is going to be for your trades. Now, since we need to be mechanical and rule-based, what we need to do is we need to create something which is called as a trade plan. Now, what happens is when you start learning a new methodology, or even when you start as a fresher when it comes to trading, it is not very easy to create a trade plan from day one. And the reason for that is that to create a trade plan, first you need to have a good enough experience of a particular methodology. And once you have good experience, then probably you can convert it into a step-by-step rule-based system. And this is where these two documents, they come in handy. So in a way, I have created a trade plan for you, which is based on demand supply trading methodology. And during these sessions, we will understand how to apply this trade plan step by step in a very mechanical way. So this document which you see, we call it as the trade plan steps. You can also call it as the flow chart or the walkthrough, which will guide us what we need to do step by step. Now, every step has its own elaborate rules, and those rules are available in the rule book. Now, mind it, this rule book that I've shared with you is a very conservative approach, because when you start learning trading, it always makes sense to start in a conservative fashion. As you start having more and more experience, you can definitely modify that trade plan to make it better and aligned with your personality style, right? If you're more conservative, you can make it more conservative. If you're aggressive, you can make that trade plan a little aggressive. But at least you do have a starting point using which you can start planning your trades very mechanically and rule based. So what is my step number one whenever we start planning our trades? Step one is I need to define my trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. So now when I'm talking about the exit can be the target, exit can be the break-even point, exit can be your trailing stop loss, exit also can be a stop loss, right? Any kind of exit. So exit doesn't mean just your profit exit. Exit can be in profit, exit can be in loss, exit can be break-even, any kind of exit. So now the question is, why do we start with our trade purpose as our very first step? And the reason we do that is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach, and that logical approach is that the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income is a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, example, let's say if we take the NSE India. So I'm pretty sure if you people trade markets which are not 24 hours, you would have experienced that whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, by holding the position overnight, we are taking that unnecessary gap risk, which cannot be avoided. So that is why my recommendation to all of you was that initially your hourlies and dailies will be done strictly as intraday trades. We don't want to keep them as overnight trades and take that unnecessary overnight gap risk. When it comes to weekly monthlies, we have no choice because this is where we are not expecting to get the exit the same day. We are definitely anticipating that these trades can last for a few weeks, maybe even few months, which is why we will have to keep them as overnight positions. But that does not mean for weekly monthlies we cannot have a gap against us. It can still happen. But since you're leaning against some bigger time frames, the probability definitely reduces. But as you start having more and more experience, you start building up confidence in your analysis. If you want to include daily incomes into overnight trades, that can be done because by definition, daily income means a trade which can last for a day or maybe even few days. So eventually it can be done. Initially, I would suggest you not to keep daily income as overnight trades. So my step one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I've selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 in the rulebook, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now mind it, this table, which is on page number 31, is specifically for the NSE market, because this market is only open for 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, like your commodities, forex, cryptocurrencies, maybe some international markets, then you can look into the table which is on page number 32. But since I'll be taking examples from the NSE, I will be referring to this table. And as I opted from my step number 1 that I want to plan monthly income trades, so from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SETS from. SETS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then my refining time frame will be the 60-minute chart, which can be used for multiple purposes, like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, I have now the clarity to what time frames I'll be using, because I opted monthly income as my trade purpose. So my time frames now are monthly, weekly, daily, and 60. Plus what analysis I need to do on each and every time frame, I also have the clarity to it. So my challenge number 1 is taken care. Now the next challenge is, if I take again example of NSE. On NSE, we have over 2000 companies listed. So humanly not possible that every day I sit and analyze 2000 companies to identify my trading opportunities. So what I need to do now is I need to have a process in place which can help me get a smaller list out of a very big list. And the more this list is in sync with my trading methodology, like in this case, my trading methodology is demand supply, the higher is the probability that I might be able to find something which qualifies based on my trade plan. Now, if you do a Google search, you'll be able to find n number of free scanner screeners, which are based on either conventional technical analysis or fundamental analysis, and they can help you get a smaller list of stocks. But the problem is that none of those indicators or scanners are based on demand supply trading methodology. So to overcome this challenge, what I did was I also created 2 custom built scanners, which are called as the demand supply zone alerts and the demand supply zone screener. Now, if you want to understand more in depth about them, how they work, how they function, how to use them, then you can definitely click on these and you can visit the product page. That is where the walkthrough videos are available. I'll also tell you quickly from the website. So once you're on a website, under services, you can see you have trading view indicators. Click on it. And here you can see you have the alerts and the screeners. So simply click on the subscribe now button. It will take you to the alerts page and the screener page. And that is where the walkthrough videos are available. Go through the walkthrough videos to understand them better. But I'll briefly help you understand how they work. So starting with the alerts. So as of now, only the crypto market is live. So you can see as in when we have formation of demand and supply areas on some of the symbols which I've selected, I will keep getting these notifications. Now let's quickly see how alerts they basically work. So here you can see I've applied alerts and currently I'm on the 5 minutes chart. And in the alerts settings, I have given a list of, you can see about 20 symbols. So what happens is that out of these 20 symbols, whenever we have a formation of a demand area or a supply area, I will immediately get a notification. Now, how will I get this notification? If you have a free trading view account, right? Now on free trading view account, you cannot create alerts on an indicator. So what we have done for you, that you will see a table on the chart itself. Like you can see currently it is telling me the last Zone was formed on ETH BTC. So if I go to ETH BTC and let's change this to crypto, sorry, ETH. So you can see on the 5-minute chart, we just had a formation of rally base drop, and that is what it is telling me. We had a rally base drop where the proximal line starts at 0.03346. You can see 0.03346 ending at 48, and you can see ending at 48. So again, somebody who has a free TradingView account, you can still use it, but the only thing is you will not be getting alerts. You will just get this table, which will keep on updating at whatever interval you are on. So if I'm on a 5-minute chart, it will update every 5 minutes. If I'm on a 15-minute chart, it will update every 15 minutes. If I'm on the hourly chart, it will update every 60 minutes, right? So depending upon whatever time frame you're on. And plus, if you have a paid account, then you can also set your alerts. And you just saw, I showed you that alert almost at the starting. So here you can see we have that log, and you can see as and when the demand supply zones are getting formed, you get these notifications. So yes, you can get your notifications if you have a paid account, or if you have a free account, you will get these updates on the chart itself. So that is how alerts, they basically work, that during the live market, as soon as you have a formation of a demand area or a supply area, it will notify you. The second one is the demand supply zone indicator. Now, how does the demand supply zone indicator works? Sorry, not the indicator, the demand supply zone scanner. Now, how does the scanner works? So here you can see in the scanner, I have given a list of about 15 symbols, and then I have said that my proximity should be 2%. So what I'm telling the scanner is that out of all these symbols, on whichever symbol the current candle is within 2% to a demand area or a supply area, shortlist it for me. So now you can see if I was doing the analysis manually, I would have to go through all the 15 symbols, and then I would have realized that on 14 symbols, we are still far away from a demand area or a supply area. So I would have wasted a lot of time analyzing those 14 symbols. But now, since I'm using the scanner, it is telling me only TCS is getting closer to demand. So that is the only one you can look into, because rest of them are still far away from demand areas or supply areas. So example, if I go to TCS, you will see that on TCS, my current candle will be closer to a demand area. Can you see we are pretty close to this demand? And again, it is telling me that from the closing, we are about 1.62% away, which means from here, if we move down 1.62%, you can see, sorry, from the closing, 1.62, we will be entering into this area of demand. So you can see I just got a notification for the alert. So if I again look into this, you will see that it is telling me that, let me check from here. So it is telling me we have PEPE USDT, right? So let's go to PEPE USDT. Let's go to crypto, and you will see just now we'll be having a formation of a zone on this, right? So that is how it works. Let's go back to, let's go to TCS. We were looking at TCS. Perfect. So this is how the screener basically works. And for the screener, the market doesn't have to be live, because we are not looking at the zones which are getting formed currently. We are looking at the candles which are getting closer to the demand areas or supply areas. So that is how these two different scanners, they basically work. So one is helping you identify symbols as and when these zones are getting formed, and the other one is helping you identify symbols when you're getting closer to demand areas or supply areas. And like I already said, that I'll just give you a brief introduction to it. If you want to understand them more in depth, you can definitely watch the walkthrough videos which are available on the product page. All right, so let's move ahead. So yes, step 2 is to get a smaller list. Now, how you get that list is completely your choice. I showed you two scanners which are purely based on demand supply trading methodology. You can use them to shortlist symbols. You can use the free scanner screeners, which if you'll do a Google search, you'll be able to find a number of free scanner screeners. But one thing very, very important which you need to remember is that irrespective what scanner or screener you're using, these scanner screeners, they never tell you what you need to buy or sell. They only help you get a smaller list. Now, once you have that small list, you will have to analyze them one by one manually and see which one matches with your trade plan. The one which matches with your trade plan can be an opportunity for you, and the ones which do not match with your trade plan, you simply skip it. And this process can also be as simple as I just want to analyze my Nifty 50 symbols, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that small list. But like I already said, the more the process is in sync with demand supply, the higher is the probability that you might be able to find something which is qualified for you, and that too from a very small list of symbols. So again, whatever process you want to use that. And let's assume that by using that process, I got a list, and in that list, the very first one was ABC. So what I need to do now is on ABC, I need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my lower time frame will be daily. And on the daily chart, what I need to do is I need to identify zone. And by zone, we mean any of these 4 structures. Now, I also have good news for you. I do understand that identifying quality demand supply areas in itself is a very big challenge. And to overcome this challenge, we have also created an indicator which is called as demand supply zone indicator. And what this indicator basically does is that once you apply the indicator to your charts, it will automatically identify where are the areas of demand and supply on that particular chart. And we are offering a free 7-day trial of this indicator, which is fully functional 7-day trial. So if you have still not tried out this indicator, you can try it for free for 7 days. Now, how do you get access to the indicator? It's very simple. Once you visit our website, you can click on services. Under services, you'll be able to find TradingView indicators, and you can see here the first one is the demand supply zone indicator. Click on it, and you will be able to find this button which says 7 days free trial. Click on 7 days free trial, and it will take you to this page. Now in this page, all you need to do is provide your full name, your email address, and your TradingView username. Now in case you don't have a TradingView account, you can click here and you can create a free TradingView account. The indicator works perfectly on a free TradingView account as well, so there are no limitations to the indicator functionality, even if you have a free TradingView account, right? So you can create a free TradingView account if you don't have an account already. And once you have created your TradingView account, identify your TradingView username, input that TradingView username in this column. And similarly, if you already have a TradingView account, you can click here, you can visit your TradingView profile, identify your correct TradingView username, and then you can input your TradingView username here. Now, after filling this, you need to choose how did you hear about us. You will also get to know when your trial will expire. Click on I'm not a robot and click on finish and start trial. Now, once you fill this form, again, a very small short form will hardly take you less than 30 seconds. Now, once you have filled this form, within 24 hours, the indicator will get activated for you. And once it gets activated, you will receive a notification on TradingView itself that now you have access to the indicator. And then you can start exploring the indicator absolutely free for 7 days, fully functional. All right, so let's move back. So what I need to do now is I need to go to the lower time frame and identify a zone. So let's assume this was the symbol which was shortlisted by the scanner or whatever process you were using. And as soon as I applied the indicator, can you see it is telling me that we have this drop based rally structure available on the chart. So let's mark this drop based rally demand zone. Perfect. So my step number 3, which was to identify a zone, again, it has been automated now. The indicator has automatically identified the zone for us and we marked that zone. Do we have a zone available? The answer is yes. Now, once you have a zone available, does not mean you can trade it blindly. The next step is to qualify it, which is a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify based on the booster scoring. So the first condition we'll check is that can this zone be a case of level on top of level? Now, why do we start with level on top of level? You will see today's example is a beautiful understanding of this concept. The reason we want to first check whether a zone is a case of level on top of level or not is because if we find that it is a case of level on top of level, we might have to shift from the zone we have already identified to a different area. So that is why level on top of level is the very first condition we look into. Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone is dividing into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, the first criteria will be my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, there is a possibility it might be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify. the zone I have identified, does it coincide with any intermediate time frame zone? And the best part is, if I go to the intermediate time frame, the indicator will automatically identify the intermediate demand supply areas for us. And here you can see we have a drop base rally structure on the intermediate time frame. So let me draw this, and I'll just change the color to differentiate between the two. So the one in pink is my, in fact, let me do this. Let's change it to black. Right, so the one in gray is my intermediate time frame zone. The one in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, right? So that is what we were talking about, that if you have an intermediate time frame zone and the lower time frame zone is part of it, we call it as a coinciding level. So this is definitely coinciding. But to be a case of level on top of level, there has to be multiple zones. And as of now, you can see we only have one zone. But what you need to remember is that for a case of level on top of level, it is not mandatory that all the zones might be quality zones. So what I'll do is I'll change the indicator settings and I'll say I want all demand supply structures, because by default it is only identifying quality areas. And as soon as I change it to all structures, you can see we also have this rally based drop structure available inside of it, right? Let me remove this black outline, then you'll be able to see it much more clearly. You can see this. In fact, let me change the color, so that might help even more to see that green one. So you can see we also have a zone below. So what we talked about is exactly what we have on the chart, that when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So this is definitely a case of level on top of level. So what do we do in case of level on top of level? We will go for the lowest zone in case of demand. So even though we started with this one, but we will not be using this now, we'll be using this zone, right? So let's mark this zone. Give me a second. So I'll not be using this one now, I'll be using this one. Let's change this to demand. So yes, it was a case of level on top of level, and then you saw that we shifted from the zone to another zone, even though this is not a quality zone, but yes, as a case of level on top of level, we will make that shift. So let's get back. Level on top of level was applicable. We made the modification. The zone is not because of a gap, therefore gap rules will not apply. Pivot no authenticity, definitely it's a drop based rally structure. So if I go back, you will see that it is a structure of a drop base rally. Now ideally we always apply the rules of pivot and authenticity to drop base rallies and rally based drop. But if you go to the rule book, you will see in the rule book you have some exceptions, and one of the exception is that in case of level on top of level, there is no need to apply the pivot and authentic rules, because that positive factor we are looking for, we already have that positive factor as a case of level on top of level, right? So we can skip the rules of pivot and authenticity in this case, and it is not unstable equilibrium. So if you look at all the applicable rules, we applied all the applicable rules. And is the zone still qualified for us? The answer is yes, because it did not get disqualified due to any of these rules. So yes, we do have a qualified area. Now the next thing will be applying the boosters and see how is the quality and the probability factor of the zone. So let's go back, starting with the boosters. The first one is freshness. The zone is definitely fresh. You can see we have been pretty close to it, but it has not yet been tested. Otherwise, the indicator would have changed the color. So we know it is still fresh, gets a score of 3. If you talk about the strength, it is not a explosive move. In fact, it is not a quality area. So that is the reason the indicator was not identifying when we had the default settings, which is for quality. But let me do one thing. Let me change it back. Right, so it's not a quality area. So we have one candle moving out. Let me try to do this. If I just change it to good move, does it still qualify? You can see with a good move, it's still identifying this zone. So we know we don't have an explosive move, but we still have a good move, right? So for good move, what we'll do is we'll give it a score of, go back, we'll give it a score of 1. Talking about time at the zone, we only have 2 candles in the basing, which gets a score of 2. Reward to risk ratio, we'll take it as an assumption because that can change based on the arrival. So with the assumption of reward to risk ratio, currently we have a score of 9 out of 10, which makes it as a high quality setup. Now talking about the location. Now if I go to the monthly chart, you will see we don't have any demand areas, we don't have any supply areas. So we have taken such cases in the past where one of the two was missing. In this case, both of them are missing, but we can still apply exactly the same logic. And that logic is, if you try to identify where is the most recent pivot low, you can see this is where we had the most recent pivot low, and that is where prices started moving up. And where is the most recent pivot high? You can see this is the most recent pivot high from where prices they started moving down. So like I always say, that logically, if the prices they move down from here, there has to be some supply, right? Prices cannot move down because of supply. Similarly, if the prices moved up from here, there has to be some demand, because price cannot move up if there is no demand, right? I'll just change the color to gray so that we can differentiate. So what will happen is, now if I start going to some smaller time frames, you will see that somewhere around here and somewhere around here, I'll be able to find supply zones and demand zones. So if I go to weekly, you can see on the weekly we definitely have a demand zone, but we don't have any supply here. Let me go to daily and let me change it to all structures of demand and supply, because they might not be quality areas, but we might still have some demand supply areas, right? So we don't have anything. If I go to 4 hours, you can see on 4 hours we have some supplies here, and in fact recently you can see we just tested that supply, and from there we started moving down. So yes, logically, if we have moved down from here, you can see there were supplies, and if we moved up from there, there has to be demand. So this is why, in case we don't have an area of demand or supply on the chart to do our curve analysis, we can use these reference point, and by using these reference point, we can draw our curve. So what I'll do is I'll draw the curve from here till here. So now what has happened is that, yes, I was still able to do my curve analysis, but instead of having now 5 divisions, we only have 3, which is low of the curve, middle of the curve, high of the curve. Very high of the curve is missing because we don't have the monthly or the higher time frame supply, and similarly very low of the curve is missing because we don't have the higher time frame demand, right? But we are still able to understand our location based on the 3 divisions. So based on these 3 divisions, you can see that we are planning our trade low on the curve, which is a good location to plan a long trade. So if you talk about our location gets a score of 1. Now talking about the trend, if I go to the intermediate time frame, you can see the indicator is automatically doing the zone violation analysis for me. It is telling me we have 1 supply violation, 1 demand violation. So since we have 1 supply, 1 demand violation, in fact, the most recent violation is of supply. You can see when the prices started moving up, the supply was violated, which is telling us that maybe from a downtrend, now the trend is shifting to sideways, which eventually might even shift to uptrend if we continue moving up. So currently we are in sideways, and for sideways we can definitely give it a score of 0.5, because at good location we can take trades even in sideways trend. Now talking about move from the zone, we need at least a 4:1 move. We probably have a move which is much more than that. So let's draw this and see how big the move is. So this is my 4:1. So this is my 4:1. So we probably have 5, 6, maybe 7:1 move. So the move from the zone that we require has already happened, gets a score of 2. Talking about level on top of level, this was a case of level on top of level. It was also a coinciding level. Now technically trap becomes relevant. The reason for that is whether it gets 0 or 1, it will still remain as a type 1 trade for us. But let's verify that can this zone work like a trap. So what we'll do is we'll take a horizontal line wherever our proximal is, and then we'll start pushing it up, trying to identify an area where prices have been bouncing over and over again. So if you look at this area, I'll say it's almost a textbook example of support resistance. You can see that in the recent past, it has almost worked like support, here also almost worked like support, working like resistance. In the past, it was working like resistance. So we have a pretty clean area of support and resistance, and now our zone is sitting right below it. So what is going to happen is that people who believe in support resistance, because of support, they would like to buy here, and their stop losses, which will be sell orders, will be placed below this area. Similarly, if we get a breakout, then breakout traders will also start selling. So by the time we start entering into this area of demand, we'll have a lot of selling coming in because of the stop losses, because of the breakout traders. And what are these people doing? They are making 2 novice mistakes. Mistake number 1, they are selling after a decline in price, which means they are now selling at a cheaper price. And mistake number 2, they're also selling in an area where the chart has proven to us that back in history demand exceeded supply, which could be the only reason for prices to move up. So yes, definitely that it has the probability that it might work like a trap. So that is why for the probability booster, we will give it a score of 1. So if you look at the quality and the probability, a score of 9, which makes it as a high quality setup, a score of 6.5, which makes it as a high probability setup. So high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know that this is going to be a type 1 trade for us. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do our proper position size calculation. Whenever the prices are back, we'll have to re-verify, because the markets are not static, markets are dynamic. Conditions are changing almost every other second. So before we enter the trade, the way we qualified it as of now, we'll just recheck that does it still qualify based on my trade plan. If the answer is yes, you place your order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management. So what do we do in trade management? Step 1, at 1:1, we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule-based. And if these sessions are helping you plan better trades, then do like the video. If you have any questions, queries, if you have any comments or feedback, you can always put it in the comment section. And very, very important, if you have any friends, family members who are into trading, or if you're part of some trading groups or trading community, then do share the link to my course content, because my course is 100% free. These live sessions are 100% free. Even they can try the demand and supply zone indicator absolutely free for 7 days. So because all this content is available absolutely free, share it with as many people as you can, because I'm pretty sure you also understand a lot of traders are struggling with trading. So you never know, these sessions might help them plan better trades and have better results. Now, before we start with the Q&As, I would also like to add that one feedback that I was getting from you people was that yes, at the end of the session, you do take the question queries, but what if I don't want to ask my questions publicly? So if you visit our website, you can see on the top right corner, you have this option which says 1-to-1. So from here, you can schedule a 1-to-1 appointment. There are two kind of appointments available. One is a voice call, and the other one is your online meeting. So if you feel that on a voice call you can ask your questions, get answers to it, you can go for a voice call. And if you feel you want to share your analysis, you want to share your screen, then you can also go for an online meeting. So this option is definitely there. But yes, you can always put your questions in the chat box during the YouTube live session, and I will try to answer all the questions, queries that we get. So let's see, what do we have for today? I'm now able to do charting with the clear picture. Thanks. Okay, so that's good. And that is what you can see. Even the idea behind all these tools I have created is designed for. In fact, if you see at the starting of the session, when we start the session, it always starts from trading simplified, right? That is what I'm trying to do for all the traders, right? For the trading community, so that trading becomes much more easier for you. And that is how these tools can help you. Not just these tools, even making the process mechanical. Even if you don't want to use these tools and you want to plan trades very mechanically, you have a rule-based system now which can help you be a better trader and plan better trades. All right, so that brings us to the end of today's session. Thank you everyone for joining in. I'll be seeing you now the next weekend. Until then, trade safe, enjoy your Sunday. Take care. Bye-bye.